Hello everyone and welcome back to the channel. Today's video is going to be a little bit different as well. We're going to be taking a look at 3 top stocks in the Magnificent 7 that I'm going to be looking at buying and at what price I'm going to buy them. Now obviously you already see on the screen the first one is going to be NVIDIA Corporation. If we take a look at the chart from the maximums that they were the previous year, they are currently down to $115. If we take a look at the 5-year history, we can see that at one point they were already all the way up here in around 145. Before we get to the intrinsic value and what I think I should pay for NVIDIA, again, this is my own opinion how I like to invest, guys. Please do your own due diligence. Let's take a look at what analysts are saying about this company. They currently have a strong buy of 4.66 out of 5, and that consists of 63 total analysts in the last 90 days. 47 strong buys, 11 buys, 5 holds, and 0 sells or strong sells. Now, if we take a look at the intrinsic value of NVIDIA, we can see that it's currently at original Benjamin Graham's formula of 143, the updated one at 127, and the analyst revised, which I barely use, is way too conservative at around $70. And even then, with these two targets and a margin of safety, the buy price would be $82.73. However, I don't think the stock will go down that much. I think NVIDIA is a giant company. It still has a lot of room for growth, and you can't really measure these companies all the same, even though you have this formula to give you sort of an idea. But I think a good buy price, or at least what I'm expected to buy NVIDIA, is going to be around the $80 to $90 mark, which just it's what it is with the margin of safety. But I think it's a long way from there. Hopefully with this market and all the crazy stuff going on, it does go down to those prices, and I'm going to load up. Again, this isn't financial advice. This is just my own opinion. And if we take out NVIDIA, taking a look at more of a discounted cash flow analysis, this is an intrinsic value. This is discounted cash flow. We can see the base case would be $113. Best case would be that the company is worth $189, and the worst case is that it will be worth $82. And this is where I want to buy at the worst case, which will be an undervaluation of about 29% from today's current price. The next stock we're going to be taking a look at is going to be Tesla. As you can see on the chart, I mean, the stock is taking a hit. This is good for me. This is good for an investor if you do want to invest in the stock, because at this prices, I think it was just way too expensive. Keep in mind, this stock was once at about $479 and is currently at $248, but this is not where I want to buy just yet. So let's take a look at the analyst ratings. Now, out of a 5 rating, the analysts have a hold, so not a buy or a sell, of 3.35. This is a total of 48 analysts in the last 90 days. They have 15 strong buys, 7 buys, 15 holds, and 2 sells, with 9 strong sells. If we go ahead and take a look at the intrinsic valuation, we can see every single metric. This stock, it is not a buy. It's definitely overvalued. The PE ratio for this stock is just crazy. Depending on the intrinsic value and the formula that you want to use, the stock will be worth between around $110 to $54. I think if you do an average of this, it's going to be around the $74 mark. And with a margin of safety, the buy price will be $64. Again, guys, I am not waiting for the stock to drop to $64. It's definitely almost near impossible. I know in the stock market, you shouldn't say impossible, but I think if this stock drops from the current price of 240 down to 150, it'll be a good buy, just because if it does keep dropping lower, you can just average down your cash and your position. And if it just goes up when you buy at 150, you still make your profits. Again, this is not financial advice. This is just my own personal opinion. And if we take a look at the intrinsic valuation, I mean, the discounted cash flow valuation, this company, the base case is that it's worth $46. The best is $146. So not even with the best case scenario, this company should be at the prices that it should be at. And the worst case is that Tesla is worth $22 per share, which I don't think this is realistic. They are investing heavy. So let's see what happens in the future. Now, the next stock is going to be Google. I think this one's probably my favorite from the bunch. As you can see, it was also down from a high of 206. It's currently now at 167. If we take a look at the analyst rating, out of 5, they have a 4.4, which is a buy. 64 total analysts, 38 strong buys, 14 buys, 12 holds, 0 sells, and 0 strong sells. Now, the reason why I say that Google is one of my favorites is because of their dividend. As you can see, the dividend growth is 0 years. That's because they just started growing their dividend. Obviously, they're not going to have a 5-year growth rate, or at least it's not updated in Seeking Alpha yet. But look at their payout ratio. It's below 10%, and you have a 0.48 yield, which this is obviously going to be increasing for the future. So if you're getting this stock at a premium price and you're also buying it at a cheap cheap dividend in the future, it'll be worth a lot more. So I think this stock is very good value. Now, if we take a look at the intrinsic formula, we can see that the high of the stock is 238, 212, and 124. If you want to buy it at a margin of safety of 35%, the stock should be worth about $137. However, this is not the price that I plan to buy it. I'm aiming for around $145 to $150 from the current price of $167. And if we take a look at the discounted cash flow valuation, we can see in the base case, the stock will be worth $161. The best case is that it's going to be worth $245, and the worst case is that it's worth $112. Now, Google, as I mentioned, is my favorite from the three. I don't think it's the one that's going to have the most growth, but I think it's the most safe play. Google's been around for a billion years. They do have a lot of market moat. Yes, you could say it's a technology company, but it's not as heavy as NVIDIA and Tesla that just drop and go up freaking 5% every single day. That's just abnormal. That's not realistic. So this is why I think is the best one. NVIDIA does pay a dividend as well, but I just prefer Google as a company overall. That's the video for today, guys. If you enjoyed, please consider leaving a like. Don't forget to subscribe and let me know which of the three is your favorite company.